If you're watching Battlefield of Survival, you already understand that history is not entertainment. It's a training manual. Before we begin, make sure you're subscribed. Hit the like button if this kind of deep historical analysis matters to you, and leave a comment with your thoughts as we go. Now, let's get straight into it. The Great Depression stock crash wasn't caused by a single event. It was the result of visible warning signs that most people ignored because optimism felt safer than caution. Those same warning signs appear again and again, including today. When asset prices detach from real economic output, danger is already present. In the late 1920s, stock prices rose far faster than company earnings, wages, and industrial output. Paper wealth expanded while real productivity lagged behind. In practical terms, investors were buying expectations rather than value. You apply this lesson in 2026 by comparing market growth to fundamentals. If stock indexes are soaring while corporate profits, employment stability, and consumer purchasing power remain flat, that imbalance signals a bubble forming. When easy credit floods the system, speculation replaces discipline. Margin buying was rampant before 1929. People borrowed heavily to buy stocks, assuming prices could only rise. When credit tightened, forced selling triggered collapse. Today, the mechanism is different, but the pattern is identical. Excessive leverage through low-interest borrowing, consumer debt expansion, and speculative instruments creates fragility. A practical safeguard is limiting leverage in your own finances. Holding assets outright, rather than on borrowed money, keeps you solvent when markets reverse. When everyday people become financial experts overnight, caution is required. Before the crash, shoeshine boys gave stock tips, newspapers promoted effortless wealth, and skepticism was mocked. Mass participation driven by hype rather than understanding is, a historical red flag. In 2026, this appears when social media replaces analysis, when complex assets are sold as can't lose, and when dissenting voices are dismissed. You apply this lesson by stepping back when enthusiasm becomes emotional rather than rational. When financial innovation outpaces regulation, instability grows quietly. The 1920s saw new investment trusts and speculative products that honestly few understood. Oversight lagged behind complexity. When pressure came, the system cracked. Modern equivalents include opaque financial instruments and markets that move faster than regulators can respond. A practical response is diversification into assets with historical resilience, such as cash reserves, tangible assets, and sectors tied to real-world necessity rather than speculation. When confidence replaces preparedness, survival favors the cautious. The most overlooked lesson of the Great Depression is that those who survived financially weren't the smartest traders, they were the most prepared. They reduced exposure early, preserved liquidity, and avoided herd behavior. Applying this today means planning for downturns before they arrive, not after. Emergency funds, low debt, and conservative positioning are not pessimism. They are historical intelligence. History doesn't repeat itself exactly, but it rhymes loudly for those trained to hear it. If this breakdown added value to your understanding, subscribe to Battlefield of Survival, like the video, Share it with someone who takes history seriously and leave a comment with what warning sign you're watching most closely.